Did you notice what happened in the bond market today? The yield on the 30-year U.S. Treasury just hit 5.31%, its highest level since 2007. And that could become a problem for stocks. Here's why. When Treasury yields rise, investors suddenly have a much more attractive alternative to stocks. Why take enormous risks chasing expensive companies if you can earn roughly 5% from a U.S. government bond for 3 decades? But the bigger problem is what higher yields do to the economy. Companies borrow money, mortgages depend on long-term rates, commercial real estate depends on financing, and corporations eventually have to refinance their existing debt. If borrowing costs stay high, profit margins can get squeezed, especially for companies that depend heavily on cheap financing. And there's another issue. Higher bond yields make future corporate earnings worth less today. That matters enormously for high-valuation stocks, particularly technology and other growth companies whose valuations depend on profits expected years into the future. That's why a move in the 30-year yield above 5.3% deserves attention. And this isn't happening in isolation. Oil has surged above $90 a barrel amid renewed U.S.-Iran tensions, adding another potential source of inflation. Meanwhile, the 10-year Treasury yield has climbed to around 4.7%. The irony? The market has been hoping for lower interest rates, but the Fed doesn't control the entire yield curve. Long-term rates can rise because investors demand more compensation for inflation, government borrowing, or economic uncertainty, even when expectations for Fed rate hikes are falling. And that's exactly what makes this situation interesting. Stocks can ignore rising yields for a while. Strong earnings can keep pushing them higher. But eventually, valuation meets mathematics. So I'm watching one number very closely, 5.5% on the 30-year Treasury. If yields keep climbing toward that level, I wouldn't assume stocks will simply shrug it off. The bond market may be sending a warning. And historically, when bonds start demanding higher returns, investors eventually have to rethink what they're willing to pay for stocks. This is market signals. Watch the bond market, because sometimes the biggest stock market warning doesn't come from stocks at all.